Alright, so every time the stock market crashes, millions of people panic. They sell everything, delete investing apps, and they promise they'll never invest again. Meanwhile, the richest investors in the world are doing something completely different. They're shopping. And honestly, the first time I learned that, I thought it sounded completely backwards. Because when prices are collapsing, shouldn't everybody be running away? Apparently not. In fact, Warren Buffett has one of the most famous investing quotes ever. Be fearful when others are greedy, and greedy when others are fearful. That sounds clever, until you actually have to live through a market crash. Because of course, it's so easy to say buy the dip when your portfolio isn't down 40%. It's a little harder when opening your investment app feels like checking your exam results after forgetting to study. And that's exactly where rich investors think differently. Most people see a crash and they see a disaster. Rich investors often see discounts. Think about it. If your favorite phone suddenly went on sale for 40% off, you'd probably be excited. If your favorite shoes drop 50%, you'd probably buy them immediately. But somehow, when great companies become cheaper, people panic instead. It's one of the strangest things about investing. Now obviously, I'm not saying every crashing stock is suddenly a bargain. I mean, some companies deserve to fall, some never recover. But history shows that broad markets have eventually recovered from every major crash. The dot-com crash, the financial crisis, and the COVID crash. Even Bitcoin. Remember when everyone said Bitcoin was dead again and again and again? At this point, has died so many times, it probably deserves its own zombie movie. Yet every major crash created people who quietly accumulated more while everyone else was trying to escape. And that brings us to something the wealthy usually have that everyone else doesn't: liquidity, which is just a fancy way of saying cash. Because opportunities don't usually appear when everything is going perfectly. They appear when everyone else is scared. If you've already spent every dollar, well, you can take advantage of those moments. But if you've planned ahead, the market crashes suddenly become opportunities instead of emergencies. I also think psychology plays a much bigger role than people realize. When markets are breaking records, everyone wants to invest. When markets are crashing, everyone suddenly becomes an economic expert explaining why this time is different. Sometimes it is. Most of the time, fear simply becomes contagious. Personally, I think that's the biggest lesson. The rich don't have some secret app or some magical stock picking formula. A lot of the time, they're simply able to stay calm while everyone else is making emotional decisions. And honestly, that's probably harder than picking the investments themselves. Because buying when everyone else is terrified feels wrong. Selling when everyone else is celebrating feels wrong. Yet history keeps rewarding the people willing to think differently. Now, does that mean every crash is a buying opportunity? Not necessarily. And it definitely doesn't mean you should invest money you can't afford to lose. But it does explain something I've always found fascinating. When the headlines start screaming, when everyone says the world is ending, when social media is convinced the market will never recover, that's often the exact moment experienced investors start paying the closest attention. Because while everyone else sees panic, they're looking for bargains. And history suggests that's usually where fortunes begin.